I hope you downloaded the illustrative financial statement I've added in your module class just to give you an idea on how a complete set of financial statements look like. Okay, and it's understandable if the financial statements that you will be looking at would be overwhelming class, considering that it is a consolidated financial statement. It's not just for a one simple entity. It's the financial statement of an entity that has a lot of subsidiaries class. Okay, but as to simply being familiar on how it looks and what it contains, then the illustrative financial statement I have shared to you would be a good material for that purpose. Okay, next would be to discuss about the reporting period. Okay, I hope you're familiar already with the various accounting periods class. You have your calendar year, you have your fiscal year, you have your natural business year. Calendar year, it's from January to December. Uh, Fiscal year, any 12-month period, uh, ending on any month other than December. Okay, other than December 31. Okay, so it can be from February to January, March to February. That would be considered a fiscal year. Okay, but if it's from January to December, that would be considered as a calendar year. Okay. Now, there was a question asking for additional discussion on monetary unit assumption, the time period assumption, and the entity or the separate entity assumption. Okay. Now, while these assumptions class are not expressly mentioned in the conceptual framework class, we have these four underlying accounting assumptions class. These are the concepts, these are the principles that serve as the basis for the accounting process class. The accounting process works, the accounting rules work because of these assumptions. Okay. The conceptual framework class mentions only of one underlying accounting assumption class, and that is your going concern assumption. Okay. Going concern assumption tells us that the entity, the reporting entity, is expected to operate in the foreseeable future. Okay, and this assumption is important, class, because this basically tells us that it's okay for us to provide useful lives to our asset class. This allows us to set collection periods, production periods, because we expect the entity to be able to operate continuously in the foreseeable future. The measurement of our assets, liabilities, income, and expenses would be very different if we are under the assumption that the entity would already go bankrupt, that the entity would already be closing operations class. Okay, all the rules that we have in the preparation of financial statements work because we are working under the assumption that the entity will not just end at this current reporting period. We are working under the assumption that the entity will continue to operate in the foreseeable future. Okay, that's why we are able to develop depreciation class, because we understand that the life of the entity is a lot longer than the life of our assets and uh, our liabilities. We are able to rely on historical measurement class, on historical valuation, because this is more verifiable and there is no need for us to use current values, since we are under the presumption that the entity is going to operate continuously in the foreseeable future, that the entity will continue to be a going concern. Okay, so there are four underlying accounting assumptions class: going concern assumption, monetary unit assumption, uh, time period or the periodicity assumption class, and your entity or your separate entity assumption. Closely related to the going concern assumption class is your periodicity class or your time period assumption. Since we want to provide timely financial reports or financial statements class, okay, but we also understand that we are working under the assumption that the life of the reporting entity is not limited. There is therefore a need for us to divide or to put checkpoints class in this indefinite life of the reporting entity. Okay, we expect the life of the reporting entity to be infinite. Okay, but for us to be able to provide timely information, we have to split this into uh, multiple reporting periods. So even if the number of years that will serve as the life of the reporting entity is expected to be at infinity class, we cannot just wait for the end of the reporting entity to provide financial reports. Okay, so enable for us to provide useful information, the information must be timely. And for us to provide timely information, we have to provide financial statements regularly. And for us to be able to achieve comparability class, then it's important that our reporting periods would be fixed from one period to another. Okay, it would betray the usefulness of the financial statements class if you prepare financial statements for a period of 6 months in one instance, and in the second instance you prepare a financial statement for a period of 12 months. Okay, there is a need to split the life of the reporting entity into certain periods class for us to be able to provide timely information. Okay, but it's important that our reporting period has to be consistent class. Okay, and normally our reporting period class would be 12 months. But if you are preparing interim reports, you may have shorter reporting periods. So again, we have the periodicity or the time period assumption as a consequence of your going concern assumption. Okay. Before proceeding to the reporting period here, as discussed in the framework class, let's just go over the other two underlying assumptions in accounting class, which are your monetary assumption, your monetary unit assumption, and your separate entity assumption. Okay. Under the monetary unit assumption class, there are two aspects here: the quantifiability of our elements of the financial statements and the stability of our measurement currency. In our case, our measurement currency is the Philippine peso. Okay. Now, understand class that our financial reports will provide information about assets, liabilities, income, and expenses. Okay. For example, our assets class is not just composed of cash class. It would be composed of other tangible assets, equipment, machinery, or it can be intangible assets. Okay, your accounts receivable or other assets that represent your rights that are not tangible. Okay, the problem here is that how will you be able to provide information about these assets without coming up with a uniform uh, label? And that is why in accounting, the quantifier that we will use class would not be units, would not be kilos class, would not be area, would not be square feet or whatever class. The quantifier that we will use would be money class. How are these assets going to be measured in terms of money? And that's basically what makes the financial reporting work class, because we are able to present assets, liabilities, income, and expenses in terms of money. So if you have something class that cannot be quantified in terms of money, then it will not be recognized. It would not be reported as part of our assets, liabilities, equity, income, and expenses. So for accounting to work class, we must use a common quantifier, and in this case, our quantifier would be money class. And for this quantifier to work class, if we use money as our measuring tool, even for assets that are non-monetary, even for liabilities that are non-monetary class, for this to work, the measurement currency that we should use should be stable class. Okay? If we want to be able to have information that is comparable, then we must have a currency that is relatively stable. Okay, that the value of the currency would not significantly change from one period to another. And if we have a currency that is stable class, then it would be very easy to verify whether or not we have the correct valuation or measurement for our assets, liabilities, equity, income, and expenses. Okay. Now you might ask, what if it happens that there is a huge inflation class, the currency that we are using becomes highly unstable or volatile class, then you need not worry class. We have a standard that will be applied for financial reports or financial statements that are prepared in an hyperinflationary economy. Okay, but for all other instances, class, we are working under the assumption that our quantifier, that our measuring tool, which is our money class, is stable. So again, accounting works because we are working under the assumption that all the elements of the financial statements can be quantified in terms of money, and our reporting or our measurement currency is relatively stable year in and year out. The last underlying accounting assumption, class, would be your separate entity principle or the entity concept. This basically tells us that the reporting entity, class, is separate from all the other persons or entities that is involved with this reporting entity. The reporting entity is not the same as the owners of the company. The reporting entity is separate from the owners, the creditors, the suppliers, the customers, so on and so forth. And it is important for us to work on this separability, class, so that we would know the limit of the application of the accounting process. If we limit the entity into this reporting entity only, then we will only be dealing with these entities' transactions, these entities' operations. What if there are personal transactions of the owners, the creditors, the employees of this company? Are we going to include that in the accounting process? The answer is no. We will only focus with the transactions that will apply or that will concern the reporting entity. Otherwise, class, it will be very chaotic, class. If we just combine or merge transactions of different entities, class, then it would be very difficult to use the financial information that would result from our accounting process, class. If you include transactions that are not dedicated to this, that are not applicable only to our reporting entity, then the information that will be contained in our financial statements would ultimately be misleading, class. It will not give us the financial position or the financial performance of this particular reporting entity. And in that case, then the information will not be useful anymore. If you have a potential investor, class, I cannot rely on a financial statement that includes transactions or operations of another entity. I will not be able to decide whether or not I should invest in this reporting entity when the reporting I am given with includes transactions that are not even specific to the reporting entity, to the entity that I wish to invest in. The information would not be useful, the information would be misleading. So it's important to set the metes and bounds of the reporting entity, class. It's important to recognize that one entity is different and separate from all other persons or entities that transact with this entity or that comprise this entity. The employees are not the same as the company. The owners are not the same as the entity. The owners can have transactions that will not affect the reporting entity. So if you're preparing the financial statements of the reporting entity, then you should only take into account transactions that affect our reporting entity. All other transactions that are not relevant to the reporting entity should not be accounted for. Because again, we are working under the assumption that the reporting entity is separate from all the persons or entities that comprise our reporting entity. If we do not have that assumption, class, then the preparation of financial statements would be very chaotic.